Hello and welcome to Market Domination Overtime. Stocks closing mixed here. The S&P 500 and the Dow both falling. Our very own Jared Blickery is standing by with today's moves. Jared.
Thank you, Josh. Kind of a bearish afternoon. Still holding on to gains in the NASDAQ, but let's check out the losses in the Dow first. You can see it's closing the day down about 465 points, or just short of 1%. A little bit off the lows, but pretty close to those lows of the day. NASDAQ Composite, meanwhile, which spent most of the day in the green, well off the highs from around noon, but still holding on to some very small gains there. S&P 500 down about 1/3%, and the Russell 2000 down a similar amount, but you can see it spent almost the entire day in the red. And we'll get to the sector action now, where only healthcare up 1%. That's XLV in the green for 1%. Also a record high. Everything else in the red here. Utilities down over 2%. And then the following in the bottom row down by more than 1. That's industrials, materials, financials, real estate, and staples. And let's take a look at the NASDAQ 100, where we see the mega caps have come back today, but some of the smaller stocks, not necessarily. Alphabet up 2.5%. Microsoft and NVIDIA up each about 1%. Meta down 1.8%. Apple off less than 1. And as I was showing just about 30 minutes ago, semiconductors looking pretty weak aside from NVIDIA and Intel, which was up 6% today. But software looking pretty strong. We got a lot of green and also some dark green in there as well. DocuSign seems to be leading the pack up about 6.7%. And if we take a look at the Dow, we can see kind of a bearish picture aside from those mega caps. You know, J&J up over 1, Amgen up 3.5%. That is a healthcare stock, but for the most part, seeing a lot of red, especially in some of those names that have been hitting record highs recently. JP Morgan, Walmart, Goldman Sachs, and the list goes on. I will leave everybody with a little bit of green here. I'm going to show you our pharma board, and there we go. In the upper left, Lilly, the biggest one here, up 4%, and that is good for a record high. I will show you the one-year chart. Haven't seen a record this year. You'd have to go back about 1 month, but Eli Lilly back to record highs, up 43% over that trailing year. And I'll send it back to you, Josh.
All right, thank you, Jared. Appreciate it. Well, Bitcoin hovering above 91,000 as crypto kicks off 2026 on stronger footing. So is Bitcoin headed for a rally? Our very own Inez Ferre has more. Inez.
Yeah, Josh, and just taking a look at Bitcoin today, it has been a bit under pressure, but still Wall Street is saying that they're more optimistic on the token's potential for a rally in 2026, at least with some of the strategists that we have been tracking. Ed Engel over at Compass Point noted that crypto is on better footing. He talked about leverage appearing to have been washed out since the big sell-off that we saw in October and also November. Also selling from long-term holders, that has slowed. And institutional demand, that is going to be the structural driver for Bitcoin going higher. But watch out, because of the levels that we've seen, Bitcoin has not been able to punch above 95,000. And what Engel is saying is that the cost basis for those investors that got in within the last 6 months is still around 98,000. So he wouldn't be chasing rallies just yet. But if you do see a break above 95,000, or above 98,000, then he would become much more bullish about a strong rally driven by that institutional demand that we were just talking about. You also have Bernstein yesterday, which said that the bottom for Bitcoin is in, basically that 80,000 level that we saw in the fourth quarter of last year. Bernstein analysts saying that that was the bottom for Bitcoin and the broader markets. Then you've got Sean Farrell over at Fundstrat, who is a big Bitcoin bull, saying that yes, he's expecting a bounce in January, but he's still expecting a significant drawdown in the first half of the year before we could see a rally in the second half of the year. And he's got a price target of 115 for Bitcoin by the end of this year. Josh?
And Inez, taking a look at another cryptocurrency, Ethereum. It's currently trading at just over 3,100. Inez, traders over in Polymarket, they're betting on whether Ethereum or gold hits 5,000 first. Right now, gold winning out, right? It's currently priced at 4,400. What are your thoughts there, Inez?
Yeah, look, so this is that bet of the clash of the narratives, right? Of gold getting to 5,000 first or Ethereum getting to 5,000 first. So currently, as you mentioned, the market is favoring gold. I would point out that gold is closer to 5,000 than Ethereum is to 5,000, even though we've seen a rally as in the start of the year when it comes to Ethereum. But Ethereum is also more volatile. So you could see prices moving to the upside much more quickly. With respect to gold, you've got the central banks that are still buying, at a record clip. And you also have this move away from the treasuries. But with Ethereum, you've got the bulls that are saying that with the financial system that is upgrading to on-chain, that is basically moving the entire financial capital markets on-chain, they are seeing more and more of a utility for blockchain, Ethereum being one of those where a lot of tokenization is happening. So certainly there is also a bull case, of course, when it comes to Ethereum and the rest of blockchain. So look, these contracts expire on the 30th of 2026. We'll get, I'm sure, a better idea in the coming months. But as I said, gold is inching, it's closer to the finish line.
All right, great stuff as always. Thank you, Inez. Well, stocks off to a strong start to 2026 with even small caps seeing gains. The Russell 2000 up over 3% so far this year. Join me now on the outlook for small caps is Francis Gannon, Royce Investment Partners Co-Chief Investment Officer. Francis, it is great to see you. So let's talk about the small cap. So Russell 2000, we're creeping back to all-time highs here, but every time, Francis, it breaks to a new high, it's kind of short-lived. I mean, in 2026, do we see a sustained breakout?
I think the leadership shift you've seen within the small cap market relative to other markets since the low of the tariff debacle last year of April 8th, through the end of the year, small caps have outperformed the Russell 1000, the S&P 500 by say 400 basis points. I think that leadership shift continues, and it's going to be driven by the fact that small cap earnings, which have been in an earnings recession for 2 years and change, are actually just the beginning of taking off.
How would you broadly, Francis, characterize valuations?
I would say valuations are pretty exciting. Valuations on a relative basis to large are as low as they've been, 25 years. Small caps have been out of favor for a long period of time. So I think the opportunity in small caps is quite large. And typically when you see small caps begin to outperform, it can last over a decade. So get on board.
We think small caps, sensitive, levered to interest rates. What if the Fed doesn't cut as much this year as maybe some expect, Francis? What if we're higher for longer? What would that mean for your coverage?
So I think, the Fed has already cut a lot, right? And if you think about the debt within the small cap space, 40% of the debt within the Russell 2000 is variable, right? So that's already kind of hit the small cap space a little bit. So if we have another cut or two, I think that's helpful. The big thing I'm going to be watching, I think, would be the 10-year. If the 10-year gets 450-ish and above, that could probably dampen a little bit of the expectations on small caps. But from my perspective, I almost don't know if that matters as much as the earnings story. The earnings story is going to be quite powerful. And for the first time in many years, this year, you should see small cap earnings outperform large cap earnings.
What about the regulatory backdrop? I mean, listen, the Trump administration, I think they would think of themselves as friends of business, small and large. I mean, how much does that play into the small cap story?
Well, I think there's a couple of stories there from a Trump standpoint. Regulatory is one of them. Less regulation is a good thing for many businesses, especially in the small cap space, and it's going to be amplified even more so in our space. Layer on top of that, some of this reindustrialization that's taking place in the United States, very helpful for small cap companies. People talk about the emerging markets being a really exciting area to invest. I would say look at the middle of the country, right? That's a true emerging market in the United States where a lot of small cap companies that are unrecognized are going to be benefiting from what's going on in terms of a lot of spending around industrial building, et cetera, throughout the middle.
I was going to ask you whether there's certain verticals in the small caps that excite you more than others. I mean, is it industrials? Is it financials?
Yeah, we are. If you were to look at the majority of our strategies, I'd say industrials is our largest overweight. Now, industrials within the small cap space is kind of a catch-all from machinery companies to service businesses, but at the same token, there are a lot of really interesting businesses there that the market is just not really focused on. At the same token, information technology is an interesting area. We're slightly overweight there. I think financials are also really interesting within the small cap space. One of the areas you've seen doing quite well in the early part of the year has been banks coming back a little bit in the small cap space. So I do think you're going to see a lot happening there going forward.
What about opportunities overseas?
I think the opportunity overseas is very similar to what you're seeing here in the United States, but it has to be on the higher quality side within small caps. And you can buy some great businesses that are number one or number two in terms of what they do outside of the United States that have great valuations in the small cap space.
Before we let you go, let's get a pick here. You like ESAB.
Yeah,
It hasn't done a whole lot over the past 12 months, but you see opportunity there. Why is that one a buy, Francis?
I think it speaks to what we were talking about in terms of the bit of an industrial revolution here in the United States. This is a company that specializes in welding equipment and consumables. And so obviously you're going to be, if we're doing a lot of building from just offices, et cetera, but also industrial equipment and plants, you're going to see a company like ESAB do quite well. And I think it's quite well positioned for what we're talking about from an economic perspective here in the United States over the next several years.
Francis, great to see you, especially on set. Thank you, sir.
Thank you.
Well, financials have been one of the standout sectors over the past year, but questions swirling around the Fed, regulation, and the broader economic outlook as banks prepare to report earnings. For more, we're bringing on Anton Schutz, Senior Portfolio Manager at Mendon Capital. Anton, always great to see you. Let's talk about this move in the financials, Anton, which has been impressive. I mean, I could look at the XLF. That's up about 15% over the past 12 months. But look at some of the individual movers, Anton. You know this. I mean, Goldman is up around 60%. Morgan Stanley, I'm just looking, it's up around 45%. How about Citi? It's up around 65%. What do we chalk this up to, Anton? What are the tailwinds here? Is this the loan backdrop? Is this deregulation? Is it capital markets activity? What is going on here?
Well, I mean, first of all three of those companies have strong capital markets groups. Obviously, Morgan Stanley, Goldman more than Citi, but Citi's still very strong. And when you think about the backdrop, right, deregulation allows for more mergers in multiple industries, right? Speed to approval. The capital markets are open, right? You can issue debt, you can issue equity. So the market's really gotten in front of these. They had good years last year in terms of earnings. The market's gotten in front of what they see as to be spectacular earnings this year. It's interesting because the group has had such a big move. Sometimes when they report earnings, it's actually sell on the news. But these companies are obviously doing very well fundamentally. And quite frankly, your prior guest, going down to the small companies, is where the real value is in financials, because they haven't moved to the same extent the large ones have moved. And yet all of those effects, other than capital markets, apply to the small banks, including takeovers. And I think we're going to see a lot of M&A activity. We could see 5% of banks in the country taken over this year, and that they'll be much stronger than in prior years. And it could even be a bigger number. I mean, all the advantages are there in scale. The regulatory hurdles for getting bigger have been removed. The Fed is obviously very accommodative in terms of lower rates, taking funding pressures off, helping credit quality. So if you think about it, the coast is incredibly clear from an M&A environment that's going to be very rapid. And obviously some of the bigger banks that we just talked about will benefit from advising some of these smaller M&A deals.
I'm just curious, Anton, also, how are the banks that you cover, how are they already leveraging AI? And I just wonder, does that help explain maybe some of the enthusiasm we're seeing here?
Yeah, I mean, I think we've seen lots of groups move on the AI trade. I'm not sure we've quite seen it, across the banking spectrum. But really where banks benefit is they're incredibly operations intensive, right? Very, very large cost bases, just moving paper around, balancing things. So AI can do a lot of that, and it's got to be internal, right? It can't be external. Regulators don't want that. But I think they're going to replace, people over time. It'll reduce efficiency ratios, and eventually it'll lead to revenue as well. JP Morgan's been a really big leader. I think they've identified, $2 billion in terms of earnings there. But, both from helping prevent fraud as well as operationally.
What about the Fed, Anton? Your expectations for our central bank this year and how that plays into your forecast?
Yeah, I mean, obviously we know we're going to get a new Fed head, so that's going to be part of the entire conversation. We did see some conversation today of the Trump administration talking about housing, right? Talking about not letting private equity, buy housing. But I think what the Trump administration is really focused on, and the Fed is going to be focused on this too, is improving the economy for housing, right? We've had two markets. We have an incredibly strong market in the equity market, and we've had an incredibly weak market in ownership, affordability for lower income and middle class Americans. So the Trump administration really wants to get those long-term rates down. It's not going to happen through Fed cutting short-term rates. So I think they'll use their balance sheet. I think they could do Operation Twist for sure as one tool. And clearly, as the tariff stuff, blows through the system, tariffs are not iterative, right? They don't build upon each other. So inflation, I expect to calm down. And I think the Fed is going to be chasing the AI trade, i.e., companies are going to be replacing people with AI. And I think that's going to lead to the dual mandate being challenged, right? Providing for full employment versus inflation. And I think inflation will calm down. Before we let you go, Anton, I do want to get some picks from you. Atlantic Union Bank shares, ticker AUB. Why is that a buy, Anton? Sure. Anytime a bank is involved in a merger, it creates confusion, creates arbitrageurs shorting the stock. They were involved in a merger, involved in a capital raise for the merger. And quite frankly, the stock's been left by the highway because it hasn't, it traded at this number a year ago. So if you think about the upside from having the number 5 market share in Virginia, being in very strong growth markets, and actually being able to benefit from cost cuts at the same time, building capital, probably buying back stock, this is an incredibly valuable franchise. In an environment where we have a lot of M&A, they're not buying others at this point in time. If they execute great optionality, valuable franchise, but they could always raise their hand and say, you know what, you're a bigger bank, you can buy us. We're out there. Pay us a big number. So I think you win either way. The type of names I look for have that optionality, right? They have earnings growth, they have levers they can pull, and yet other people would like to own those companies. And how about this one? Nicollet Bank shares, ticker NIC. Yeah. That's up around 20% over the past 12 months. You still like it? How come, Anton? Well, I mean, I wish I'd found this company years ago. And again, your prior guest talked about the Midwest and some of the growth that's coming there. These guys are in the Midwest. They're also in the middle of a transaction. They're going to have some of the best metrics in the entire banking industry. Return on assets, return on tangible equity, lots of capital. They'll be able to buy back stock once they close their pending deal for Midwest One, and a very entrepreneurial management team. I think they're going to be one of the consolidators of choice in the Midwest. And I think every deal they've done has added tremendous shareholder value. So I really like the path for this company. Anton, always great to see you. Appreciate your time and those picks. Thank you. Great pleasure. Coming up, what's the best positioned stock among lifestyle brands? An analyst shares his winners and losers next on Market Domination Overtime. While consumer sentiment remains subdued to start the new year, lifestyle brands are starting 2026 with an attractive price tag for investors, that is. Our next guest points to selective opportunity despite macro uncertainty. Joining us now is Stifel Sports and Lifestyle Brands analyst Peter McGoldrick. Peter, it is good to see you. So maybe just start right there, Peter. For 2026, you talk about selective opportunity for investors. Walk us through that. How do we discern winners from losers, Peter, against this backdrop? What am I screening for as an investor?
Yeah, absolutely. So thanks for having me on. Stifel's out with our 2026 preview on lifestyle brands. After a challenging 2025, we're eager to turn the page into 2026, and we see valuations at historical lows. And this gives us opportunity to be selective. We see opportunity for those of structurally improving businesses, underappreciated growth models, and those where battered businesses that have opportunity for sentiment re-rating.
You do also, Peter, in the know, you do highlight a theme we talk a lot about on the show, a K-shaped consumer. How does that impact, Peter, where you see opportunity this year?
Yeah, absolutely. The higher income households have been driving spending. We expect that dynamic to persist. So we see the opportunity for brands who have who are bringing performance innovation to scale to the consumer. Those are likely to be advantaged, and the consumer is yet to push back on pricing where they see sufficient value.
What do you think, Peter, margins are going to look like for your coverage universe this year with tariffs still in play here?
Yeah, look, so 2025 tariffs were announced, we're going to get our first full year of tariff impact in 2026. That's a headwind to margins across the space. That means prices are going higher, and on a company-specific basis, companies have the ability to look elsewhere in their P&L to find opportunities to sustain their margins. Margins are going to have some pressure, but we see this as something that we can move past into 2027.
You know, it's interesting, Peter, though, because we're waiting now for this Supreme Court decision. We'll see when we get it. But what if they came out, Peter, and they said, okay, you know what, Trump's tariffs, they're illegal. Have you tried to sort of game out what the ripple effects could be in your coverage universe?
Yeah, the ripple effects from that are the stocks are going up if they throw away the tariffs. I don't think that's a base case scenario. There are other ways for tariffs to be implemented, whether it be through a category or a country of origin basis. So all else equal, I'm considering the tariffs to be in the numbers. I think that's well understood by market participants, and I think stocks are cheap here.
Let's get to some picks while we got you. You like On Holdings, stock's down about 10% over the past year. How come, Peter? Why is that one to buy?
Yeah, On is a pure play growth company. This has best visibility to the highest growth rate in all of footwear and apparel. They're going to grow 20% plus. They're winning over customers. They have a new growth driver in Asia Pacific, and this is just a different growth animal. So we see from a low single digit share in footwear, this could move much higher, and with execution, we think the stock goes higher too.
How about Levi Strauss? Now they're around 85% of analysts on the street like this one. You do too. How come?
Yeah, so Levi is benefiting from a denim trend and a structural move towards higher value businesses. That's women's and their own DTC businesses, their e-commerce and their stores. So we see opportunity for margin and revenue to move higher. The stock's inexpensive, so this thing could move higher.
And finally, Peter, squeeze this one in. Wolverine Worldwide. Now that stock has slid about 20% over the past 12 months. You think that's an opportunity?
Yeah, so Wolverine Worldwide is in the middle innings of a turnaround. They've fixed their balance sheet problems. They now have the two main brands, Merrell and Saucony. Over 60% of their business are as strong as they've been in many, many years. So we see that as driving the entire income statement higher, with opportunity for revenue growth to inspire higher margins. And from 10 times PE, this could move higher towards $25.
Peter, great to have you on the show today. Thanks so much for your time.
Thank you.
Time now for what to watch Thursday, January 8th. Going to start off on the labor front. We'll be getting some fresh jobs data on Thursday with initial jobless claims. Economists forecasting that number to swing by 13,000 compared to the previous week to 212,000, signaling some softening in the labor market, but not a breakdown. Moving over to housing, weekly mortgage rates from Freddie Mac are coming out on Thursday. Current rate of the 30-year fix is sitting at 6.15%. Rates have fallen for 3 consecutive weeks, a welcome sign for home buyers who continue to face elevated rates and affordability issues in the housing market. And taking a look at earnings as well, some more corporate reports are coming in on Thursday. Tilray Brands announcing results for the second quarter, that's after the markets close. Analysts expecting the company's Q2 results to show pressure on its beer business. That's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend, and I've got you covered for the next half hour with the latest and greatest market-moving stories. Stay tuned.